What's up, Dan? It's Guys here, and if you watch Graham Stephan at all, you know he is a bit negative. I'm here to give you a balanced approach and tell you exactly where he's wrong.
Inflation declined in October to 7.7%, which was below expectations and 0.5% less than we saw the month prior. This was also the smallest 12-month reading since January, which means that Jerome Powell could actually be doing his job. In fact, the Consumer Price Index rose just 0.4% from the month prior, suggesting that on a year-over-year basis, we could be heading towards an inflation rate of less than 5%.
This is massive news, and if you haven't tracked, but recently, interest rates actually took a dive of nearly 3/4 of a point. Had nothing to do with the Federal Reserve lending rate. So if you don't know this already, the rate at which people are borrowing money from the bank isn't always directly tied to the federal lending rate.
So why is it going down exactly? Well, we saw a net decline in the net cost of medical care, apparel, used cars and trucks, gas and energy. Everything else like food, shelter and transportation still increased, but at a much slower pace.
Do you hear what Graham said here? Everything else still increased, including shelter. I think it's absolutely hilarious. You go and you watch any one of these YouTubers that are online and they make all of their clickbait on the housing market's going down 50%, everything is crashing, the new Fed does this, are they trying to make a recession? And all of a sudden, he quotes the actual data, which I harp on over and over and over again. Follow the data, not the hype or the headline.
It was also found that the only cost to have substantially gone up was fuel and gasoline, which was 20% higher than the month before, likely from the news that OPEC would begin cutting production in advance of a potential consumer recession. Now, of course, it's really important to understand that not all items in the report are weighted equally. After all, you wouldn't expect to spend as much money on apparel as you do shelter, unless you're Kim Kardashian.
Duh.
So because of that, each component affects the CPI number differently. And in terms of October's report, it was found that the index for shelter contributed to over half of the monthly increase.
I love how he tries to emphasize this like this is some big deal. Obviously, when the proportion of your budget, which is about 1/3 for most people and has been true forever, if you go to 2009, 2012, 2015, 2019, about 1/3 of everyone's budget goes towards housing. So when interest rates go from 3 to 7%, the fastest rise in modern history, like it makes sense that these budgets have gone up and drastically. This is just not news to me.
In terms of the deeper numbers, we're gonna have to discuss what's called the core inflation. Just like the headline inflation was up 7.7%, once you exclude food and energy prices, core inflation came in at just 6.3%, finally pulling back from its 40-year high. This was below analyst expectations, and just like the last, shelter made up the majority of that increase, with Rent.com showing that in September, housing payments increased by 8.8%.
All right, a couple things to pay attention to here. One, it did come in below expectations. That's why interest rates came down. Because interest rates for lending tend to follow inflation more than they do the federal lending rate. That is good news, and that's why you saw them lower recently. Second thing he picks up here is rents and what those decreases have come down to. I've said this multiple times. You always pay attention to year over year rather than month-to-month data. Rent prices tend to follow the same cyclical nature as housing prices. They are a little bit lower during winter, a little bit higher during summer, but you want to pay attention to year over year. Now, if that's the comparison between summer to summer or winter to winter, peak to peak, trough to trough, that's more important to pay attention to.
Of course, the downside is that these inflation readings don't include actual rent increases, and instead they use what's called the owner's equivalent rent.
This is a really good point by him. I'm really glad that he brought this up. Let's pay attention.
This is obtained by asking homeowners, if someone were to rent your home today, how much do you think it would rent for monthly, unfurnished and without utilities? This brings up the major concern that many homeowners would have no idea what their home would actually rent for, and because of that, a lot of this is dictated by opinion and not fact. In reality, there's a big discrepancy between the actual rent increases and the rent increases being reported.
Okay, Graham, buddy, a big difference. The biggest difference on this freaking chart is 0.2%. That's not a big difference. That's nowhere near a big difference. What are you talking about?
Not to mention, if you take a look at the chart, which compares the Schiller Price Index to that of owner's equivalent rent, you could see just how far apart they are.
There's a massive problem here in comparing this chart. I just said a few minutes ago that if you look at the CPI index, the majority of people's budgets usually is about 1/3 when it goes to housing. The Case-Shiller National Price Index is price, not payment. And so you want to pay attention to what is the proportion of the payment that comes out of people's household budget. This chart here does a much better job of pointing that out. And so it would be much more accurate to say that the proportion of people's budgets has actually been at historical lows for the last decade, and because interest rates have risen so drastically, that it's put it at an all-time high in the last several decades.
So in terms of what this means for the stock market, the housing market, and the future of housing prices, here's what you need to know, because this is the actual data.
All right, we'll see if he actually quotes any data here.
Now, before we talk about what's soon happening in the stock market, we first have to talk about the real estate market, since this makes up almost half of our entire inflation reading. On a broad scale, like I mentioned earlier, consumer confidence fell to its lowest level ever since the survey began in 2011.
So the first piece of data you're quoting is consumer confidence, which is a measurement of feelings. Okay, let's keep listening.
People now believe this is the worst time to buy in the last decade.
Well, with thumbnails like these, I wonder why there's not confidence in the market, Graham.
Even more alarming is that almost 40% of people expect home prices to drop in the next 12 months, and that might very well come true.
Way to CYA there, Graham. It's really easy to just say, well, that could possibly come true, and you quote zero data. It's just like, hey, I just want to make sure that I cover the worst possible case scenario, not point to any data that actually could support that I need a balanced approach. I'm just going to go ahead and say, oh my God, fear and greed, fear and greed.
But the issue isn't so much whether or not housing prices will come down, but instead what the rents will do. See, when it comes to inflation, rental prices tend to be sticky in the sense that once you sign a lease, you lock in those payments for 1 to 3 years, regardless of what's happening with the overall market.
I don't disagree with him totally here, but the rental market is not static. It's not fully sticky. Just because you put your house up on the market for $1,400, it rents out, and let's say it's a 3-year lease, doesn't mean that someone the very next day isn't putting their house on the market. People are tracking to see what houses rent for on a day-to-day basis. So I just don't really agree with him here.
So even though you might be paying $4,000 a month for a 300 square foot studio in San Francisco, someone else might have to pay $4,400 a month if they were to sign that exact same lease today.
Point in case.
This means that rental prices tend to lag other economic indicators, and calculating exactly how much rents are increasing or decreasing is rather difficult.
I totally disagree here. The MLS and apartments do a very, very good job of tracking rents. They pay a lot of money and economists to do that for them to always make sure that they're maximizing profits.
Now, the good news for tenants is that rental prices are beginning to drop, with some of the largest cities currently down 2 to 6%.
If you actually go to the article that he's quoting, it's month-to-month data and not year-over-year data. Year-over-year, every single one of those marketplaces is still up. It drives me nuts that he does this.
This might not sound like a lot, considering that rents are already up 50% in the last 2 years.
Here's this point that I'm trying to drive home here. He quotes one article that shows month to month and says that they're down. But if you look at this chart put out by the Fed, show me one place on this chart where rents went down year over year. One. Show me one. It's not there.
But as conditions begin to soften, landlords are beginning to price their properties in line with reality.
This is just so freaking frustrating. He's trying to demonize landlords, saying, oh, they're totally without reality, because he's going to get everyone who's renting on board saying, oh my gosh, they're charging all these rents and they're greedy landlords. Oh, look, we're so bad and evil. But the point being here is that every landlord, anyone on the planet, tends to maximize what they're trying to get for rent-wise. If you put it up for $14.50 and it doesn't rent within a few weeks, guess what you end up doing? You lower the rent because you don't want it to be vacant, because if it's vacant, you're not making money on the property. I'd much rather have a property that I have it filled that's paying me slightly below what I had hoped for than it would be to go vacant. And that's why you see the cyclical nature. Are there more renters during summer or more people looking to rent during winter? And that's why that cycle ends up happening.
Although in terms of what's happening with home prices, researchers at Goldman Sachs expect a decline of 5 to 10% peak to trough, with their official forecast model predicting a 7.6% drop.
Now, this is just absolutely lovely. The article that he ends up quoting quotes a average of 7.6% drop coming from Goldman Sachs. And he's about to quote another one from Moody's, which is around that same percentage. And it's over a near 2-year period of time. Not 5 months, not 6 months, not a 30% drop in the next, oh my gosh, by summer. It's a measured response of actual data. It's hilarious to me how many YouTubers do this. They sell you on gloom and doom, but when they actually quote the data, it's always way better than what they have said, always.
Now, others like Moody's expect housing prices could drop by as much as 20% in areas like Nashville and Idaho.
There's my point. You go to the article and it's as high as 20% in the worst possible case scenario.
Along with 10 to 15% in locations like Phoenix.
And what happened to the 14 other thumbnails that you had up recently that shows a 40-50% drop, Graham?
Or basically all the areas that saw a massive run-up during the pandemic are likely to come down to late 2020 pricing.
I've said it once, I'll say it before. The ones that are hyperinflated are the most likely the ones that come down the most. The ones that had very measured increases are the ones that are unlikely to see cutbacks in their housing prices.
However, the housing market usually takes a long time to adjust to new information, unlike the stock market, which is immediately beginning to feel the effects.
I'll end with this last little piece. The 2007 crash had way more going for it. There were tons of loans that should never have existed. That correction of nearly 20 to 25%, depending on the market you're in, and they were worse in some cases, took 5 years to happen. 5. It's not going to happen today.